Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Opendoor.
If you find our talks useful, please consider subscribe, like, and comment underneath. I mean, it really helps out. But I want to set up a wealth building puzzle for you today.
Ooh, a puzzle. I like where this is going.
So imagine you're looking at a company that just reported its financials, and honestly, the headline numbers are terrifying.
Yeah, they really are.
I mean, we're talking about a company that watched its revenue shrink by nearly $1 billion. They dropped from $5.153 billion in 2024 down to $4.371 billion in fiscal year 2025.
Which is a massive haircut.
Exactly. And on top of that shrinking top line, they posted this massive, eye-watering $1.3 billion loss.
Yeah, that's the number that makes everyone panic.
For most retail investors, seeing a 10-figure loss next to vanishing revenue is, the ultimate signal to just run for the hills.
Oh, absolutely.
Yet, underneath those terrifying headlines, the smart money is quietly accumulating shares. Insiders are writing massive checks with their own personal wealth. And one contrarian analyst is out there predicting an 1,800% upside.
Yeah, it creates this massive disconnect, right, between the surface-level headlines and the underlying structural reality of the business.
Literally.
Because we are looking at a classic shrink-to-grow transformation here. I mean, this business is no longer a distressed, capital-intensive house flipper.
Which is what everyone still thinks they are.
Exactly. But they're actively transitioning into an AI-driven, capital-light software platform. And they actually commanded 67% share of their dedicated market right now.
Okay, so the idea of shrinking to grow sounds great in, like, a business textbook. But I have to put myself in the shoes of someone just scanning the newsfeed.
Right, the average investor.
Yeah, losing $1.3 billion on paper is a staggering amount of money. How do you defend a business model that is bleeding cash at that scale while deliberately making less money?
Well, you really have to look at how that $1.3 billion number is categorized. It was reported as a GAAP net loss.
Okay, GAAP.
Right, GAAP stands for Generally Accepted Accounting Principles. It's basically the standard rule book companies have to follow when reporting financials.
Right.
But under these rules, not all losses mean cash is physically leaving the bank account to keep the lights on,
Wait, really? So it's not all actual cash burn?
No, not at all. When you look under the hood of this specific report, $933 million of that loss was a one-time non-cash charge. It was specifically for debt restructuring and extinguishment.
Hold on, so almost $1 billion of that loss wasn't operational burn.
Exactly.
It wasn't them, like, buying houses at the top of the market and selling them at a loss because their algorithm was broken.
No. It was a completely proactive move to clean up their capital structure. They essentially ripped up bad, expensive legacy debt.
Oh, wow.
And that action is incredibly painful to GAAP earnings. It forces you to take an accounting hit that makes the quarterly report look like an absolute disaster.
Right, it looks terrible on paper.
But it drastically de-risks their future capital structure. They eliminated future interest payments and obligations that were going to just choke the business. So if you strip away that $933 million accounting hit, the underlying operational reality is actually stabilizing.
Okay, so it sounds like ripping off a very expensive financial Band-Aid.
That's a great way to put it.
Right, like it leaves a massive, ugly mark on the balance sheet for the year, but it prevents an infection from taking down the whole body later on.
Exactly. And the proof of that restored health is actually sitting on their balance sheet right now. Despite the massive paper loss, they ended 2025 with about $1.1 billion in cash and cash equivalents.
That's a huge liquidity cushion.
It is. And that's alongside $925 million in housing inventory. They stabilized the ship. Shrinking the revenue from $5.1 billion down to $4.3 billion was a conscious choice.
They stopped chasing scale just for the sake of scale, right?
Precisely. In the past, the strategy was to buy every house they possibly could just to inflate the top-line revenue numbers, even if the profit on those houses was negligible or even negative.
Right.
Now, they are focusing entirely on unit economics. They're making sure every single transaction actually makes sense.
Okay, but having $1 billion in cash and cleaning up the debt only really matters if the new, smaller engine is actually profitable.
Right.
Like, if they are buying fewer houses, those houses need to generate significantly better returns.
And they are.
Yeah, because we have the Q4 2025 data, and there was a 30% earnings beat plus a 46% sequential jump in homes bought. But the metric that really stands out to me, the one that's wild, is the contribution margin.
Oh, the margin expansion is huge.
It is,
Right.
because the full-year margin was a razor-thin 1.0%, but the new book, meaning the homes they acquired late in 2025, under this new disciplined approach that's generating margins between 4% and 6%.
Yeah, that jump from 1% to the 4 to 6% range is the ultimate validation of what management is calling the Opendoor 2.0 thesis.
It's a massive leap.
In financial terms, we call that a 300 to 500 basis point expansion. 1 basis point is simply 1/100th of 1%.
Okay.
So when your business is transacting billions of dollars in real estate, expanding your margin by 300 to 500 basis points doesn't just improve the quarterly report. It fundamentally alters the long-term profitability profile of the entire company.
I understand the math of the margin expansion, but I want to know how it is physically possible. I mean, real estate is notoriously rigid.
Very rigid.
You have agents, you have physical inspections, negotiations, completely unpredictable repair costs. How is a company suddenly extracting 4 to 6% margins on these new acquisitions when the rest of the industry operates on the same traditional frictions?
Well, they aren't using the traditional frictions.
But they must be doing something drastically different in the engine room, right?
They absolutely are. They are shifting entirely from manual real estate valuation to algorithmic pricing and rolling out what they call the exclusives marketplace.
Okay.
But the real mechanism driving these margins is the complete overhaul of the underwriting process. They integrated AI video inspections, which literally collapsed the underwriting time from hours down to under 10 minutes.
Wait. How does a video inspection replace the traditional process? If I am selling my house, an inspector usually comes out, walks the property for like 2 hours, writes up a physical report, and then someone at a desk has to calculate how much it will cost to fix the water damage or the cracked tiles.
Exactly, that's the old way.
How do you do all of that in under 10 minutes?
Okay, so instead of dispatching a human inspector who has to drive across town, the homeowner simply walks through their house with a smartphone camera.
Just their phone.
Just their phone. The computer vision AI instantly analyzes the footage. It detects outdated countertops, it spots the water damage on the ceiling, and it identifies the cracked tiles.
That's crazy.
But it doesn't stop at just identifying the damage. The algorithm instantly cross-references those specific repairs with localized labor and material costs in that exact zip code and automatically adjusts the purchase offer.
In real time.
In seconds. Without a physical inspector ever getting in a car, they have created what is essentially a zero-touch transaction protocol.
Wow. I mean, that explains how they are doing it so fast, but the cost savings must be staggering.
Unbelievable savings.
Because going from a fleet of physical inspectors and desk analysts to an automated system has to eliminate a massive amount of overhead.
They actually reduced the underwriting team per home from 11 employees down to just one single person.
11 to 1.
Yes, 11 to 1. And that lean infrastructure is exactly what supports the margin expansion. Because when you don't have to pay 10 extra salaries, cover driving time, or deal with human bottlenecking on a single transaction, your unit economics transform overnight.
That makes total sense.
That is exactly why their overall hosting costs are now below $5 million. They are running this operation like a lean tech software company, not a heavy traditional real estate brokerage.
Okay, so squeezing out the operational fat on the transaction itself makes sense, but you still have to find the people who want to sell their homes in the first place.
Right, lead generation.
And customer acquisition is notoriously brutal in real estate. You have traditional agents spending absolute fortunes on bus stop benches, direct mailers, and digital ads just to get one listing.
Oh, it's incredibly expensive.
So how are they acquiring these sellers without bleeding cash on marketing?
This is where their partnership with Zillow comes into play, and it addresses the concept of SAC, or customer acquisition cost.
Right.
TAC is simply the amount of money a company has to spend on marketing and sales to get one new paying customer.
Oh.
And in real estate, the SAC is incredibly high because it's a high-friction, really infrequent transaction.
People only move every few years.
So
So instead of trying to outspend Zillow on Google Ads to get the attention of a home seller, Opendoor essentially built a Trojan horse.
yes, that's exactly what they did.
They serve as the fulfillment engine for Zillow's instant offer feature. They don't have to spend massive amounts of money fighting for customer eyeballs. They just sit quietly inside the biggest real estate search engine on the internet.
Right.
And when a homeowner is browsing Zillow and clicks the button to get an instant cash offer, Opendoor's infrastructure processes the transaction. They tricked their biggest potential rival into handling all the expensive customer acquisition for them.
Trick might be a strong word, but functionally, yes.
Mm.
By embedding themselves into Zillow, they drastically lower their CAC. Zillow gets to offer a cool feature that keeps users on their website, but Opendoor gets the actual real estate transaction and the resulting revenue.
That's brilliant.
It's also a massive structural barrier to entry. If you are a smaller competitor trying to build an automated home buying service, you physically cannot compete with a company that already has a captive audience on the world's most trafficked real estate site.
You're just locked out.
You are locked out of the primary funnel. That's why they're effectively sidelining smaller players and controlling 67% of the dedicated market right now.
And we are seeing the results of this efficiency and how fast they're moving inventory, too.
Yeah, the velocity is improving.
Because the share of homes they hold for more than 120 days dropped from 51% down to 33%.
That's a huge drop in stale inventory.
Right, so they're buying smarter with better unit economics, underwriting in minutes with AI, acquiring leads cheaply through Zillow, and getting the houses off their balance sheet faster.
Exactly.
It paints a picture of a beautifully tuned machine. And I have to ask this forces a very uncomfortable question.
Okay, let's hear it.
If the structural turnaround is this solid and the AI moat is this deep, why is Wall Street treating this stock like a radioactive asset?
Right. Well, assessing a corporate transformation of this scale requires looking past traditional trailing metrics.
Which Wall Street hates doing.
Institutional investors and traditional analysts absolutely hate uncertainty. When they see a company pivoting its core model, incurring massive gap losses, and relying on new technology, they tend to heavily discount the stock until the transition is undeniably complete.
I have to play devil's advocate here, though, because the skepticism isn't just quiet institutional doubt.
No, it's very loud.
Jim Cramer recently went on television and explicitly labeled this a meme stock.
He did.
He directly questioned the durability of their fundamental model. And frankly, considering management has diluted shareholders in the past and posted those terrifying headline losses we just talked about, doesn't Cramer have a point?
It's a fair question.
Why should the broader market trust that management actually has this under control?
Look, Cramer is voicing the exact frustration of the traditional institutional mindset, which really struggles to assign a valuation to a company during a messy, multi-year transition phase.
It's easier to just write it off.
Exactly. It is very easy to look at the historical volatility, the previous missteps, and just slap a meme stock label on it for a quick television soundbite.
Right.
But you have to look at who is taking the opposite side of that trade.
Right. Who's buying?
Contrarian analysts, like Eric Jackson at EMJ Capital, are looking at the exact same data and arriving at a completely different conclusion.
Jackson's the one with the crazy price target, right?
Yes. He recently placed an $82 price target on the stock, which is predicting an 1,800% upside.
That's insane.
He is betting heavily that the broader market is entirely mispricing this radical corporate transformation. Furthermore, Zacks currently has it as a rank number 3, which is a hold, signaling that the extreme bearish sentiment is actually starting to balance out.
An 1,800% upside is a wild projection, and, analyst price targets can sometimes be just as noisy as television sound bites.
Fair point.
But we are seeing actual institutional accumulation happening under the radar. Heavyweights like Morgan Stanley and Jane Street Group are building positions.
The smart money is moving in.
But the ultimate counter to the meme stock narrative, for me at least, is the insider conviction. The CEO, Kaz Najatian, and the co-founder, Eric Wu, are making open market purchases.
Yes, and the magnitude of that insider conviction cannot be overstated.
No kidding.
Late in 2025, Eric Wu participated in a $40 million private investment deal.
$40 million?
$40 million. Insiders do not throw $40 million of their own personal wealth at a meme. They don't lock up that kind of capital for a joke or to generate a quick retail pump.
Right, you don't gamble $40 million on a sinking ship.
Exactly. They do it because they have access to the internal dashboards. They see the AI underwriting times. They see the 4 to 6% margins on the new book before the public does. And they know the turnaround is structurally sound.
When founders are writing $40 million checks, it completely changes the gravity of the situation.
It does.
And because they are trading at such a depressed valuation compared to their historical highs, there is persistent market chatter about speculative mergers and acquisitions.
Oh, the M&A rumors are everywhere.
Right. There are rumors that a fintech giant like Block or even a revitalized Zillow could just acquire them outright. I mean, if you are Zillow and Opendoor's AI is already powering your instant offers, why wouldn't you just buy the company at a discount and own the transaction engine entirely?
It makes a lot of strategic sense. An acquirer could easily step in, take advantage of the depressed market cap, and instantly own a fully functioning AI-driven transaction platform without taking on the legacy risks and years of research and development required to build it from scratch.
Buy versus build.
Exactly.
Right.
But even if an acquisition never materializes, the current technical setup and the upcoming macroeconomic catalysts make this a fascinating standalone play.
Well, let's look at what the stock is doing right now and the specific triggers investors need to watch. Looking at the technicals, this stock staged a 196% rally from its mid-2025 all-time low of 51 cents. It's currently trading in the $4.30 to $4.65 range.
Right. Solid recovery.
But even with that massive surge off the bottom, it is still 58.7% below its 52-week high of $10.87.
And that gap indicates vast room for mean reversion if the profitability continues to materialize. If you look at the momentum indicators, the RSI is sitting completely neutral, bouncing between 40 and 60.
Okay, remind us what the RSI tells us here.
Right, so the RSI, or Relative Strength Index, measures the speed and change of price movements. A neutral reading means the stock isn't overheated or overbought by retail hype, nor is it oversold.
It's just waiting.
Yes, it is consolidating. It is building pressure and waiting for a directional breakout. Furthermore, the short interest is elevated at around 12.5%.
Okay, meaning there are a lot of investors betting against the stock, borrowing shares to sell them with the hope of buying them back cheaper later. But if the company releases overwhelmingly positive news, all those short sellers have to rush in and buy shares to cover their positions, which triggers a violent short squeeze, driving the price up even faster.
And we have a major catalyst coming up that could be that exact trigger.
May 7th, right?
Yes. On May 7th, 2026, they are hosting their first quarter 2026 financial open house.
Okay.
It is a video live stream featuring a live shareholder Q&A using Robinhood's Say Technologies platform. The market consensus expects management to confirm a 35% quarter-over-quarter growth in acquisitions and reiterate their aggressive target of buying 6,000 homes a quarter by the end of 2026.
Wow, 6,000.
Yeah. If management delivers those numbers with confidence, it could definitely force the shorts to cover.
The internal mechanics of the business seem coiled and ready, but we have to talk about the massive external risk hanging over the entire real estate sector.
Oh, absolutely. The macro environment.
This specific business model is hypersensitive to the macroeconomic environment, specifically the Federal Reserve and mortgage rates. We saw a perfect example of this sensitivity on April 8th. The stock jumped 4.40% purely because global oil prices collapsed.
Right, because everything is connected.
Exactly. Lower oil prices mean lower inflation expectations, which boosts the market's hope that the Fed will actually cut interest rates. The stock's tension is entirely controlled by the Fed.
It is. The core risk here is a resurgence in inflation. If inflation spikes and the Federal Reserve is forced to halt rate cuts, or worse, raise interest rates again, that is the ultimate bear case.
That would be brutal.
It would completely freeze housing inventory nationwide, leaving the company holding assets in a stagnant market. To understand why rates are so critical to this specific business, you have to look at a phenomenon economists call the lock-in effect.
Explain the mechanics of that lock-in effect for us. Why does the Federal Reserve controlling the cost of borrowing dictate whether this AI platform succeeds or fails?
Well, think of the current housing market like a massively clogged highway, where no one wants to give up their spot in the fast lane.
No.
Right now, millions of homeowners have mortgages locked in at around 3% from a few years ago.
Golden handcuffs.
Exactly. So even if their family is growing and they want to move to a bigger house, they refuse to sell their current home because taking out a new mortgage at 7% would literally double their monthly payment.
Right. They can't afford to move.
They are financially locked in. That completely freezes housing inventory across the country. Nobody sells, which means there's nothing for Opendoor to buy and process.
But the moment the Federal Reserve begins a sustained cycle of rate cuts and mortgage rates drop to a level that homeowners can actually stomach, that freeze thaws.
Exactly.
The highway unclogs. Homeowners finally list their properties, and housing velocity returns to the market.
And housing velocity is the absolute lifeblood of this company's transaction model. When volume returns to the market, they get to run that highly efficient, AI-driven 4 to 6% margin new book engine at full throttle.
They just need houses to process.
Exactly. They are perfectly positioned to capitalize on a thawing market with their leaner infrastructure. That is how management is targeting adjusted net income break-even by year-end 2026.
Okay.
They do not need a massive housing boom where prices skyrocket. They just need the freeze to thaw, so their unit economics can scale with volume.
And it seems like the market has already factored in a lot of that macroeconomic fear. You mentioned earlier that the stock is heavily discounted relative to its peers.
Yes, the macro risk appears heavily priced in. The stock is currently trading at a forward price-to-sales multiple of a mere 0.81.
8-1. Wow.
Right. To put that in perspective, the industry average is 3.67.
That's a massive difference.
It is. A price-to-sales multiple simply measures how much investors are willing to pay for every dollar of sales a company generates. At 0.81, investors are paying less than $1 for every dollar of revenue. The market is pricing this stock like a distressed legacy home buyer that is going to go bankrupt.
But in reality, based on the mechanisms we've unpacked today, it is a high-margin, capital-light software platform dominating its niche.
Precisely.
So, bringing all these complex threads together, the agonizing but necessary debt restructuring, the incredible jump from 11 underwriters to 1 using AI video inspections, the brilliant Zillow integration solving customer acquisition, the massive $40 million insider conviction, and the technical setup waiting on a Fed rate cut. What is the final investment thesis for you?
Synthesizing all these data points, we give this a bullish score of 7 out of 10.
Okay, 7 out of 10.
This is a 12 to 18-month hold. You hold this position through the upcoming 2026 rate cut cycle and wait for that operational profitability to finally become undeniable on the GAAP balance sheet. The asymmetric upside here is massive for investors who are willing to weather the near-term volatility and look past the terrifying headline numbers.
It requires looking past the surface and really understanding the technology driving the shift. And, it leaves me with one final thought, something I really want you to ponder long after we wrap up today. We just spent this time breaking down an algorithmic engine that can inspect a property, calculate local repair costs, underwrite the risk, and purchase a home in under 10 minutes, requiring exactly one human being in the process. If that zero-touch protocol is successful and it inevitably becomes the new standard for how we buy and sell homes, what happens to the millions of traditional real estate agents out there, are we not just watching a single company's financial turnaround, but the slow, inevitable death of the traditional brokerage model itself?